Corporate outlook in FY18 mirrors FY17 outlook, though prolonged sluggishness in corporate EBITDA growth portends a challenging time ahead. On one side, credit pressures will continue on investment and commodity-linked sectors, and on the other side, consumption-driven sectors will see improvements in cash flows. This also reflects in India Ratings' outlook on sectors and its ratings. India Ratings' sectoral outlooks on capital-intensive sectors like steel, thermal power and telecom are negative. Rating outlooks on power and telecom are stable and stable to negative, reflecting regulated pass-through of costs and sponsor support respectively. Outlook on oil and gas remains stable, reflecting higher realizations for upstream government-owned entities and lower subsidy receivables from government-owned downstream entities. Private oil and gas entities benefit from strong cash flows despite expectation of softening in gross refining margins during FY18. Auto and auto ancillaries maintain a stable outlook driven by improvement in volumes and limited debt on balance sheets. Corporates in India have been in the midst of a structural deterioration in nominal cash flow growth over the past 5 years, driven by low capacity utilizations. The problem of leverage for highly capital intensive sectors has been stubborn and stress levels remain elevated. Commodity prices have provided a breather in the past 2 years to EBITDA growth, but a fiscally expanding global economy could pose challenges in FY18. With limited pricing power, cash flow risks on account of increase in commodity prices and interest rates remain risks to cash flow improvements. Risks from China have diminished but still remain the most significant for Indian corporates in FY18. We expect the pace of downgrades in numbers to slow down in FY18 compared to FY17. However, given the debt intensity of sectors with a negative rating outlook, value of debt impacted may still remain high, though relatively lower than FY17. We expect a large part of our portfolio to maintain stability in ratings, given that the structural deterioration in the negatively impacted sectors has largely been reflected in rating actions taken during the past 2 years. A comparison of our ratings with the fundamental analysis clearly highlights that our ratings in the higher categories, which is A and above, are on entities which have strong cash flows and asset quality. Based on our analysis of the top 500 corporate borrowers, we think a major part of the stress is behind us, though it would be still early to say that the peak level of stress has been achieved. While incremental stress will be visible even during FY18, the quantum and proportion in relation to the overall problem should remain small. Given the stress across sectors, opportunities for mergers and acquisition activity remain tremendous. However, the biggest stumbling block remains the disagreements in valuations and the extent of debt haircuts required. However, consolidation in sectors like telecom and power could still be a possibility during FY18. Further, entities in the auto and auto ancillary space could look at opportunities outside to beef up their product and distribution suites. In summary, all in all, FY18 will remain a cautious year for corporates with improvements in nominal revenues, some pressure on margins, increase in working capital, limited capex requirements, and limited changes in leverage metrics. Tail-end risks like a China slowdown and or a sharp depreciation in the currency could derail recovery and further add to the overall stress.